Hi, fellow investors. I hope you're all doing well. My name is Chris, and I'm back here with another investment topic. So, quick question for you. Do you buy stocks of companies on the same day they become public, perhaps through IPO or direct listing? These are the two of the common ways for a private company to become public. Investing in the first few weeks after the listing is very risky as the share price is usually inflated with so much hype around it. If you invest in the first month or even on the first day, when the hype dies down, it could be brutal as retail investors like us are left holding the bag. So, as a long term investor, I prefer to wait to research the company better. The first earning releases as a public company would reveal a better insight to their business, and waiting for this information to become available would lead to a better investment decision and often provide a better chance to buy the share at a more reasonable price. So with that, in this video, I'll review three interesting companies who recently became public in the last 6 months: Airbnb, Coupang, and Coinbase. So Airbnb went public on December 9 through IPO with a market cap as of today, June 14, is $91 billion. And Coupang is e-commerce leader from South Korea that went public on March 11 through IPO as well, and the market cap as of today is 68 billion. And the last one is Coinbase, which went through direct listing on April 14, 2021. Before going any further, this is not a financial advice, I'm just sharing my personal opinion. Always do your own research before making investment decisions. So just a quick note before going to each company in more detail. The major difference between direct listing and IPO is that one sells the existing stocks while the other issue new stock shares. In a direct listing, employee and investor sell their existing stocks to the public. However, in an IPO, a company sells part of the company by issuing new stocks. It's the more expensive option as the process is facilitated by underwriters, usually provided by investment banks. So, besides the share dilution, IPO usually has a lockup period preventing existing shareholders from selling their shares before their expiration date. So, companies that use direct listing usually don't need substantial additional capital. They are relatively well known with easy to understand business model. So to illustrate the point earlier why buying share on IPO or direct listing date is very risky, let's see how the three stock performed since they went public. So if we look at Airbnb here, the opening price for retail investor was 146 due to the overwhelming demand, and it goes up to 165, much higher than the IPO price of 68. It went to all-time high around mid-February. It has been down significantly since then. Today it's close to what it was on the opening price after the IPO. So for Coupang here, on the IPO day, the IPO price was 35, but it goes up to 69 before closing at 49. So it has been down and rebound a bit after the release of their earning on May 12th. And Coinbase has a similar story. So it had a reference price of 250, but it opened at 381 and it went as high as 429 before closing at 328. So there was pressure as well here as insider unloading almost 13 million shares. It dropped after releasing their first earning on May 13 and has been down a little bit after that despite the great earning result, and the sell-off is likely affected by the drop of cryptocurrency prices as well. So anyway, in the three charts here, as you can see, buying on the first weeks or on the IPO day or direct listing day is very risky. So let's have a look at the first company, Airbnb, ticker symbol ABNB. So the company doesn't need much introduction because it's a global brand. It's worth repeating that they are disrupting the traditional hotel industry by providing unique experiences and often at a fraction of a traditional hotel room price. Also, sometimes people prefer renting an entire home rather than hotel room. In addition, you may be able to find Airbnb destination in a more remote area that don't have hotel. You can also find all kind of different unique spaces all over the world like tree houses, castle, igloos, boat, villas, cars, and so on. So they also have a scalable business model. It's free to list your property on Airbnb and they charge 3% from host of the reservation cost and from the guests it's 6 to 12% depending on the price of the reservation. So in a post-COVID-19 world, travel would resume and Airbnb is in a perfect position to benefit from the expected surge in demand. In fact, with this anticipation, the company mentioned that it's doubling the number of support agents and they have rolled out sweeping user changes and upgrades to improve interaction between hosts and guests recently. So far, compared to other online travel platforms that are geared more for professional sellers like hotels and guest houses, such as Booking.com and Expedia, Airbnb deals with private landlords and is the leader in this area. So, with the seemingly infinite supply of housing and the massive global travel market, the growth potential is huge. Compared to the other online platforms like Expedia and Booking.com, it's the most expensive out of the three in terms of price to sales because Airbnb is not profitable yet. But it has been profitable before in 2018, but the COVID pandemic has hurt them a lot with their expensive and growth plans. It's not expected to be profitable anytime soon. So since IPO, Airbnb has reported earning twice, but I was not too impressed with the Q4 2020 because of the massive loss and the much higher valuation back then. So the result of the first quarter this year shows more promising recovery on the business. So let's have a look at the detail. So they measure the night and experience book, which is up 13% to 64.4 million. And the gross booking value is even more impressive, which is up to 10.3 billion, 52% year over year. And as you can see here, the revenue is basically back to pre-COVID level. There is significant loss here which is expected as they need to pay debts, but the adjusted loss is much better compared to the previous quarters. The revenue here might seem low, but what's encouraging is the gross booking value which show how much was booked during the quarter. However, it's not really recognized as revenue until the travel actually happens. So of those large increase in gross booking value, which is up 52% here, the revenue won't be reflected if the trip is not scheduled in the same quarter, which is likely the case given a lot of the places were still affected by COVID restriction. With this, I would expect a much stronger revenue growth for the remainder of this year. The other interesting metric is gross booking value per night and experience book, which increased 35% year over year. So the disruptive business model, slightly lower entry point because of the drop and the recovery shown by the last quarter here, have convinced me to start a small position in this company. So we'll see how they do from here. Okay, so the second company is Coupang, ticker symbol CPNG. It's also well known as the Amazon of South Korea. It's the leading e-commerce platform in the country with 24% market share as of 2020. So the company put a lot of emphasis on customer experience and their customers seem to love the platform. It was named the best application of the year by Google Play and voted the most popular app in 2020 by Korean user. So in addition to the core e-commerce business, Coupang has growing business in digital advertising, grocery and food delivery as well. And they even have non-e-commerce investment that includes Coupang Pay, which is a payment service, and Coupang Play, a video subscription streaming service. So why is Coupang often considered the Amazon of South Korea? So the platform itself is designed to deliver a superior customer experience with more seller available. It provides better selection for the customer and lead to better customer experience. And with the better customer experience, more customer would come to the platform. So by increasing the scale, Coupang can lower the price of the items that they offered, and this in turn leads to even better customer experience. So achieving this allowed the company to build more service that improve its customer life exponentially. So I find this fitting to their campaign, which is creating a world in which customer can imagine living without Coupang. So the so-called Coupang flywheel is very similar to that of Amazon. In addition, Coupang has significant investment in technology, operation, and logistics to provide winning feature like dawn and same-day delivery or next-day delivery, effortless return, allowing customer to simply tap a button and then just leave the item outside their door for pickup. They also even have option to deliver without packaging and more item selection compared to the competitor in South Korea. So Coupang announced its first quarter earning result on May 12th. So in terms of total net revenue, it's up 74% year over year to 4.2 billion. The active customer is up 21% from 13 million to 16 million. So to put this into perspective, Korea has around 50 million people and 25 million are already a user, and of the 25 million, 16 million is active. So a customer is considered active if they order at least once during the period. So the other important metric is the revenue per active customer, which is up significantly 44% to $262. The net loss here is significant. Of that, 87 million are share-based compensation related to their IPO. So the other non-e-commerce specific business contribute 399 million of the total 4.2 billion revenue. So obviously e-commerce income is impacted by COVID. So things that I would watch out for should I decide investing in Coupang is the revenue per active customer should remain high to justify that the increase was not only because of COVID. Also, Coupang is the leading e-commerce platform now, so it will be interesting to see if it can continue to maintain and increase its lead. So they have also made significant investment on the delivery networks and other non-e-commerce services. So it will be encouraging if this positively impact their revenue in the long term. In terms of risk, there could be volatility with IPO lockup expiration, although I'm not too worried about this as some shares were unlocked early in mid-March already. So the other question mark that I have is if Coupang could compete in the international market with their plan to enter Singapore. I'm convinced that they can be very successful in Korea, but their growth would be limited if they don't expand their operations successfully abroad. It remains to be seen if they can maintain their revenue growth post-COVID. I've already invested personally in C Limited, the Amazon of Southeast Asia, and Mercado Libre, the Amazon of Latin America. So for now, I'll keep the stock on my watch list. So the third company is Coinbase, ticker symbol COIN. You probably know this company already. It's the largest cryptocurrency exchange platform in terms of trading volume in the United States. So it provides services to retail and institutional investors to buy and sell cryptocurrency assets. It also provides cryptocurrency related products such as USD Coin, Coinbase Card, which is a debit Visa card allowing customers to spend cryptocurrency anywhere Visa is accepted, and Coinbase Commerce, which is the cryptocurrency payment service for merchants. So the majority of the revenue, 95%, comes from transactions, and they are already a profitable business with more than 56 million verified users. So Coinbase in a few ways are closely tied to Bitcoin. Based on their Q1 earning result, 62% of the asset they hold is Bitcoin, and it also contributes to 39% of the trading volume on the platform. The number 2 cryptocurrency asset is Ethereum. So Coinbase released their first earning quarter this year on May 13 following the direct listing on April 14. So let's have a look at the financial summary. They had an explosive quarter with total revenue basically tripled from last quarter to 1.8 billion compared that to 585 million the previous quarter. The other important metric is the monthly transacting users or MTU, which is up 6.1 million. So the trading volume and the asset on the platform increased significantly as well, and that is understandable given the rise of cryptocurrency prices in the first quarter this year. So it is interesting to see that contribution from institutional quarter over quarter increased significantly more compared to retail investor. And the trading volume trend here for Bitcoin quarter over quarter perhaps can tell us how dependent are they really on Bitcoin. So as you can see here, the trend is becoming lower, but it's not consistent because there are some increase here as well. So there was an increase in Ethereum, which is up to 21% in the last quarter, but the total trading volume and asset hold is still significantly higher on Bitcoin. So having looked at their earning release, they're actually doing much better than I expected. They make 95% of their revenue from transaction. So to me, increased competition from other cryptocurrency platform could hurt them as they would need to lower their fee eventually to stay competitive. So in relation to the sentiment that their share price is closely tied to Bitcoin, that's true in terms of how much demand there is for Bitcoin. So in their S1 document, they mentioned that in the last 6 months of 2020, they saw correlation between crypto asset volatility and trading volume begin to weaken, but the correlation between Bitcoin price and trading volume remained. So with cryptocurrency rally cooling off according to Coinbase research here, the volume remained strong in May as the price of Bitcoin started to drop, but in the first 8 days of June, the daily average trading volume for Bitcoin dropped 47% from 77 billion to 33 billion. So it will be interesting how it goes from here. If the trading volume remains consistently higher despite the lower Bitcoin price, then that would be a good sign for Coinbase investors. So having researched the company more, it's better than I expected initially in terms of financial. Especially the operating margin is quite impressive. With the recent drop in the share price, the valuation is also less expensive considering that it is profitable and growing, and the projected forward PE is 26. However, at this time I prefer waiting to see the monthly trading volume trend. Anyway, if you find this is helpful, consider to like the video and subscribe to the channel as it will help others finding this video easier. If you have any feedback or different opinion on this, feel free to drop a comment down below and see you next time.